You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. Now, let's open the playbook and get started.
Welcome in to Options Playbook Radio. My name is Brian Overby. I'm the author of the Options Playbook, and I'll be your host for about the next 10 minutes here on OPR. Today's date is Thursday, October 30th, 2025, and it is the season. We have over 800 companies that are going to be announcing earnings this week, and a lot of the Mag 7 companies will be announcing, including Apple and Amazon. Google announced yesterday. The stock went up after their earnings report. We're going to focus on Amazon today. I always like to look at Amazon because for some reason Amazon always likes to announce on Thursday after the close, which means that the Friday expiration effectively becomes a 0 DTE option. So I'm going to do a trade that is going to focus on the fact that we have a fairly high priced, well-known underlying stock that will announce on a Thursday and will have pumped up implied volatility on the Friday option contracts. And we will do one of my favorite strategies around earnings, which is an open wing butterfly to get bullish on Amazon after their earnings report. Now, this will be a very speculative trade, and it's not meant to be a recommendation in that it's going to be a one-day trade. We're going to use the October 31st expiration, which is Friday. Happy Halloween, by the way. And we're going to focus on where the expected move is at. That's going to be our middle strike of our butterfly. We're going to open a wing, and I'll explain that a little bit more when we get into the strike prices, but that will allow the stock to run to the upside. So if we blow through all the strikes in our butterfly, we will still be profitable on the trade. The max risk will be the net debit paid, just like a standard butterfly. So anywhere below our lowest strike call option that we're going to be using, we could lose whatever debit we paid for the trade plus any fees to get into the trade. So a very speculative trade centered around earnings that only has one day to live. We are taping OPR before the open on Friday, October 30th. Amazon closed yesterday at $230.30. It was up $1.05 on the day. We'll be using the October 31st expiration. Happy Halloween, by the way. And we're going to go a little bit out of the money. We're going to be buying the 230 strike call and then selling 2 of the 245 strike calls. And then we're going to stop short and buy 1 of the 250 strike calls. This is what makes it an open wing butterfly, and I'll explain the benefits of that shortly. The midpoint based off of the prices yesterday for the option contracts would be $2.18, which means that for every 1x2x1 open wing butterfly that we would establish, it would cost $218 plus any fees, and that would be our max risk. Our max upside would be the difference of the long call spread, which is 10 points wide, minus that $2.18, or $7.82 if we were lucky enough to get Amazon to stop right at the middle strike of our butterfly, which is $245. The max that we can make if Amazon shoots through our strikes to the upside and closes above the 250 strike, the butterfly should be trading for $5 at that point in time. And based off of the fact that if we could execute at the midpoint of $2.18, that would mean that we could make $282 or $2.82 anywhere above the 250 strike call option. Now, why is that the case? Well, in a standard butterfly, the width between the long spread and the short spread are usually the same. So in our instance, our long call spread that makes up one part of our butterfly is 10 points wide, from 235 to 245. The short spread, though, is only 5 points wide, and the short spread brings in the credit, but we stop short on the short spread. And so 10 minus 5 means that anywhere above the highest strike in our open wing call butterfly, that the difference between the widths of the spread is what the butterfly should trade for. So if we have a 10-point wide long spread, a 5-point wide short spread, then that effectively means that we have $5 left. And if we trade above that 250, that's what it should trade for. You subtract out the net debit paid, which was $2.18, and effectively $2.82 would be left over. Obviously, got to think about fees and commissions. So with all that said, the expected move on Amazon is about 15.5 points. So with the stock trading right around $230, we're targeting that expected move. So after earnings, if the stock does basically what is expected, it would. But the expected move doesn't have any regard to direction. So we need that move to be a bullish move to the upside. And we're just trying to target what the marketplace is implying the move could be by the end of that Friday expiration. So we're taking advantage of what the market is telling us to try to pick the strikes that we are going to use, and we're going to make this effectively an inexpensive trade relative to just buying the 235 strike call, which at this point in time is trading for, at the midpoint, $5.80 or $580 for one call option. We're going to get the benefit of buying that 235 strike call, but because we can sell two of the 245 strike calls, we can greatly reduce the cost of this trade relative to buying that 235 strike call outright. Now, obviously, we don't have unlimited upside like if we bought a call option, but we do know that our maximum risk will be limited to whatever we execute this trade for, and as mentioned earlier, that's $2.18 if we could fill at that midpoint. Now, I like butterflies around earnings, and it is very speculative to only go one day, but ideally when you're looking at butterflies, you want volatility to be high in regards to option prices. You want volatilities to be high because butterflies are cheaper then. And if you're correct on your forecast, you want volatility to come in or go down or time decay to happen. And in our instance here with Amazon announcing on a Thursday, both of those things will happen very rapidly. We'll have a decrease in implied volatility most likely after that earnings report, and that doesn't even necessarily matter because we only have one day for these option contracts to live. So if I look at this trade, we're talking about prices before the open. Now, usually you would get, if you're doing a strategy that's based off of an earnings report, you usually would do it a little closer to the close. So you would kind of apply the same concepts and maybe adjust your strikes a little bit. To summarize the trade, we're looking to do an open wing butterfly around Amazon's earnings with an October 31st expiration. We're going to be buying the 235 strike call, selling 2 of the 245 strike calls, and buying 1 of the 250 strike call. The net debit, based off of the midpoint of the option contracts from yesterday, is $2.18. Our max risk will be $218. Our max upside, if we stop right at the 245 strike right at expiration, is $7.82 or $782. That's it for this episode of Options Playbook Radio. Please do check out optionsplaybook.com if you'd like to learn more about these strategies, and we'll be back next week with a new strategy from the Options Playbook. Thanks for tuning in.
You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.